Hey everybody, it's Scott Wirtanen with Honest Rate. Welcome back to the channel. Today we are talking all things VA interest rate reduction loan, otherwise known as the IRRRL or the IRRRL or the VA streamline, whatever you want to call it. It's all the same thing. But let's dive in. So let's talk about a few things today. So number one, what is it? Number two, what are the benefits? Number three, what are the VA requirements versus individual lender requirements? Um, and then let's talk about some of the common maybe misconceptions out there that you may or may not know about this product. So let's go through it. So as we mentioned, number one, what is the interest rate reduction loan offered by the VA? So the simplest way to put it is it's allowing veterans to go from one VA loan to another when there is a net tangible benefit that the VA determines, which traditionally means you're lowering the interest rate and you're lowering it at least 0.5%. But there are some other nuances that VA will allow as a net tangible benefit. So what are just like the high level highlights of why someone would do this IRRRL program over a non-VA loan or just a regular VA loan? So first and foremost, the reason why it's dubbed the streamline um, is because it's a much easier process. So you're not going to have to jump through all the same hoops with the loan process as you did if you bought the house with VA or if you did your last loan as a cash out with VA. So what are some of the hoops you don't have to jump through? Traditionally, most lenders do not require an appraisal on the VA IRRRL. And if they do, they're not doing the full VA appraisal. In most cases, they're doing either a computer AVM, or I've seen some lenders do conventional appraisals. But the vast majority of lenders out there are just using whatever the value was last time. So if it was a purchase, they'll use the purchase price. If you did a refinance last time, they're going to use whatever that value was, and just forego doing an appraisal altogether. Number two, you don't have to do the pest inspection or any other inspection. Even if you had to do an appraisal, you don't have to do jump through those other hoops. Number three, traditionally you're not verifying income. We'll get into a little bit here next about what's called lender overlays, but the VA guidelines essentially say in most cases you're not verifying income. If you're employed, self-employed, not verifying all of those documents. If you're receiving VA disability benefits, we can get that electronically on what's called your certificate of eligibility, aka your COE. So really, the idea is it's easy. You're not providing the documents that you did before. You're not jumping through a million hoops. And then the last piece of it is it's generally a lot more cost effective than a traditional VA loan. So depending on your VA disability status, you may or may not pay a VA funding fee. So if you have to pay the VA funding fee, it is significantly reduced. It's a 0.5% of your loan amount that's added versus when you buy the home, it might be upwards of 2-3% of the loan amount. So significantly less expensive. And then traditionally, if you're not needing an appraisal and other inspections, it's saving you a lot of money there. So let's talk about some of the general rules and then some of things that lenders may require on top of the general rules. So sort of the highlights is that VA requires that you've made 6 payments on the loan and that it's been 210 days from when your first payment started to when you close on the new loan. So let's say you bought the house in January, but you didn't start making payments until March. So they would look at March 1st and say 210 days from March 1st. And then that day is when you can close on the new loan. If you started in March, then you have to make 6 payments, but usually the 210 days is longer than the 6 payments. So that will cover you. Now, In that rule, there are a lot of lenders out there that will tell you they have to be 6 on-time payments. That's not necessarily the case. That is a lender rule, not necessarily the VA specific guideline. And we'll talk about that in a minute, but VA publishes their general rules, and then lenders are accountable to ensure that they're underwriting and financing loans that they feel will fit VA guidelines. So lenders can sometimes add on top or can interpret what VA says differently from lender to lender. So it's not always the same. A rule like that, 210 days, pretty easy to understand. VA spells it out. Rules like mortgage payments and what a lender is comfortable with on your payment history may change. So I've seen lenders say you just can't be actively late when we close the loan, which means if you called us today and you were 30 days past due on the loan, we could look at your options, save you some money, potentially talk through starting the process. And then between now and closing, you got to get your loan caught up. I've also seen lenders say, we are not going to start unless you've had 6 on-time payments, meaning nothing's been more than 30 days past due in the last 6 months. And that's the benefit of working with someone like Honest Rate, is that we are comparing and essentially shopping multiple different lenders, multiple different investors, not only to find you different interest rates and options, but to ensure that your scenario fits what's allowed by that lender for qualifications. So that's general highlights as far as qualifying. Couple other ideas behind that is VA requires that you have a net tangible benefit. And in most cases, they're looking at lowering the monthly payment and comparing that to the closing cost. They're not adding in their funding fee in this calculation, but all of the other fees that may be associated with your loan. And they're saying you have to recoup that inside of 36 months. So what does that mean? A good example is, let's just say you have, and I'm using round numbers here, you're lowering your payment by $100 a month, and you're adding $3,600 in the actual closing cost. So again, that's not factoring in the funding fee, that's not factoring in any taxes or insurance, just the closing cost. Well, the $100 savings divided into the $3,600 in closing costs means you recoup those closing costs in 36 months. That's allowed by the VA. Now, let's say you're saving $200 a month, but the closing cost is $8,000 added to the loan. The VA would say, it doesn't matter. Even if you like it, even if you want to save it, we will not allow the interest rate reduction loan because you're not recouping inside of 36 months. That also makes it a little difficult to lower the term of the loan. In most cases, if you got a 30-year, traditionally you can't go down to a 15-year. And then also they have some nuance around going from a fixed to an adjustable rate or an adjustable rate to a fixed that we can always dive into a little bit deeper. But essentially, VA tries to put in some guidance to ensure that lenders are doing right by you as the veteran, as the consumer, in that there's a true net tangible benefit. And then the last piece around some of the general VA rules is traditionally whoever's on the current loan needs to be on the new loan with VA. Now, again, that's not a hard and fast rule. There is some nuance to it. They do spell out in cases of, if a veteran passes away and the spouse needs to streamline it, or if there's a remarriage. So they have some guidance. Some of it's black and white. Some of it's a little gray. So if you have a scenario, talk to us. We'll figure it out. It's probably a good chance that we've seen it before. In worst case, we can contact VA directly and ask them what we should do and how we should proceed. All right, so that brings me to the last point, which is what are some of the common misconceptions and what are some of the crazy things that I hear that unfortunately, like lenders and brokers are telling homeowners. So I think the first one, the most important one, is that VA is not guaranteeing the interest rate. VA does not set the interest rates. The rates can vary from lender to lender. What's true is that, a lot of cases there can be a range from lender to lender. So it may not be like crazy outside of the ordinary. One lender is not going to offer 8% while the other offers 4%. But you can, in any given day, find some differences. You may find lenders that are really, really focused on the 30-year fixed and their pricing is better. You may find lenders that are telling you, hey, there's a 5-1 ARM, meaning it's a 30-year loan, the rate's fixed for 5 years, and these rates are so much better. And then you have lenders that aren't interested in those. So it does make sense to look around and check, because it's not guaranteed by VA. Number two, you might have lenders tell you that their rules are VA rules, and it's hard to tell. VA does publish their handbook, and you can find it online. If you feel like pulling up the PDF, you can find it yourself and read it. It's hard to digest. It's hard to understand. Heck, it's even hard for mortgage professionals sometimes to find what they're looking for. But going back to what I talked about previously in this video, there is guidance from VA on things. And there are certain things that are set in stone, like the 210-day rule that I referenced. It doesn't matter if a lender wants to do it in 209 days. VA says you can't. So if they did, they would be out of compliance with VA. But what it doesn't limit is lenders can add what's called overlays, and they can add on top of what the VA says. So if the VA says, we don't need an appraisal, the lender might come and say, yeah, well, we want an appraisal. Or the lender might say, the VA might say, we're only going to review the mortgage history on the credit. And we really don't care about the score. But a lender might come back and say, we want to view the whole credit report. And we do care about the score. And here's the score that we require for the streamline. So again, it pays to look around. That's why folks like me exist as we're a broker, because I don't just represent one lender or one lending institution. We represent many. So while one lender may tell you, hey, we don't care, the other one says we do care. And again, navigating those rules is really important, because you might find something you love as far as an interest rate, but if you don't meet the checks and balances with that lender, you're never going to get it done. So working with an expert will help you. The last couple things that are I don't know if they're misconceptions, but things that just get brought up in the process. But when you're redoing the loan, traditionally there's 1 or 2 months between when the loan closes and the new loan payments start. A lot of people tell you you're quote unquote skipping those payments. It's a little misleading, because you're not like forgiven of those payments. It's just that you're going a month or two without having to start the new loan, which, don't get me wrong, for a lot of folks looking to save money, that's what they need. Do they care about paying the house off in exactly 30 years from today, or 30 years and 2 months because my loan is starting 2 months from now? In most cases, the average American isn't paying their house off in 30 years. They're not sticking with the same loan. They're looking for cash flow. So you are saving cash flow, but you're not forgiven of that payment. You're just waiting a month or two till the loan starts. And then the last piece that can be a little confusing is if you include your taxes and insurance in your payment, which most VA loans do. The new loan is essentially picking up where your old loan left off and ensuring that taxes and insurance are collected up front. So let's say you're closing a loan in December, and your first payment is in January. Well, depending when your taxes come due will depend on how much we need to collect up front. If your taxes come due in January and your first payment's in January, well, we're going to have to collect that full amount up front to pay immediately. If your taxes aren't due until December, well, we don't need to collect the full amount. We'll probably collect a couple of months. You build a little cushion in there, and then as you make your payments, over the next, whatever that is, 10, 11 months, we'll have enough for your taxes. Why is that important? Because you have money with your current lender in an escrow account. So what happens with that money? So it depends what your current lender is willing to do. Some of them will apply it towards what you owe them. And then that way they subtract it off your balance. The new loan would add it to your balance. And it's very close to a wash. Not factoring in taxes, insurance increasing, or those quote unquote skip payments. But some lenders don't. So we would have to account for the taxes and insurance up front. You would then get a refund from your current lender, depending on their policy, usually within a few weeks after closing. And then it's up to you. Do you want to save that money? Do you want to reapply towards the loan to get your balance back down? But those are really the common things that we see that folks are having questions about. I could go on for days. I'm sure if you're watching this video and you've done this type of loan before, or if you're a fellow mortgage person, there might be some things I didn't cover 1,000% of the VA Streamline program, but I try to give you the highlights. Hopefully that answers a lot of your general questions as you were looking around online. And as always, we are here to help. We're here to serve. So if you need more information, go to honestrate.com, all one word. Give us a ring at 216-998-0123, or feel free, email me directly at scott@honestrate.com. Thank you again for watching our videos. We truly appreciate getting the opportunity to chat with you. And as always, we hope you learned something today. We'll talk to you soon.